What I want to know from you,
Yeah.
first off, is how has 0DTE changed the industry from the business side and from a trader side?
Okay, well, I have a lot of history in this business, so I have to tell you my career on the on the trading floor. Essentially, I made 80+% of the money I made was trading on or around expiration. If they had daily expirations when I was trading on the floor, you would never see me again. I'd be somewhere, it would be insane because that's where I made all my money. As a screen-based trader, I rarely trade 0DTE's other than for the first hour in the morning, maybe, because I don't like giving up all that kind of control late in the day with with zeros. But the markets have changed. There's lots of things that are different. The real question is not about me or you. It's about how did it change the business. And what zeros have done is they have created another pool of liquidity, like a giant pool of kind of intraday liquidity that has done a couple things. A, where everybody thought it would add a new element of potential outlier risk and unquantifiable risk and volatility. It's actually done the opposite.
Compressed vol.
It's compressed vol for sure. But more importantly, it has added a significant amount of volume, which has brought a lot more high frequency market makers to the game, which in turn has made the entire industry so much more efficient. And it's created, enough additional revenue so that we have better exchange technology, better innovation, better market making, and better markets all around everywhere else. So it's basically brought so many more players to the option world that it's been great for every aspect of the business.
Let me ask you this question. There are now new ETF products.
Yeah.
They don't have a ton of AUM yet. These are tiny. It's almost not worth bringing up, but it's the idea. It's XDTE, I believe, and QDTE. They're products that basically do covered calls on the S&P, covered calls on the NDX. And the idea is to sell out of the money calls on the underlying. When you start seeing ETF products that make it really easy to package up short vol strategies, does that make you nervous? Knowing what happened back in Volpocalypse, where whenever you start packaging up, whenever you see short volatility strategies become the mainstream, does that start to make you a bit nervous about market structure, the potentials to have tail risk?
Anytime I see any kind of growth in any kind of, let's call it structured product, it gives me, it's a red flag. So it doesn't, so if you go back to 2008, you saw massive growth in closed-end funds that were all covered call funds. I think in 2000, from the end of 2007 to the end of 2008, there was like 160 closed-end funds all doing covered calls that were sold as packages from like every brokerage firm, from Bear, from Merrill, from all these firms that no longer exist even today. But they sold all these closed-end funds. Every single one of them blew up. Every single one. But remember, a covered call fund is is very one-dimensional. It's a bullish play, and in a closed-end fund environment, there's not a lot of flexibility. If you're talking about it on a 0DTE basis, you're talking about 1 day's worth of risk. So if you think about it structurally, I like it a lot better than anything we've ever had in the past. But would I ever use it? Never. What do I need? First of all, it's a bullish play, and if I wanted to get long, I could do other things. I mean, I would just sell a put or something. But the other thing is, why do I want to give control? Why am I paying somebody else a hefty, I don't know what the fee structure is, but it's got to be over a point. I mean, why would I ever pay somebody? If you're going to do it every single day, you're going to pay, 250% over the course of a year. Just think about it. The math doesn't work. I don't know what the fee structure is, but I'm guessing the math doesn't work.